One morning, when you opened your eyes, the world had changed. That morning, the headlines echoed one sentence: King Ulrich has declared war. And the stock markets crashed. In the Kingdom of Xland, tensions were high. Troops were gathering along the island border. Rumors filled the streets. No one knew what was coming. But that morning, King Ulrich made a decision. It was clear. It was firm. He stood before the entire nation and said, "Today, war begins." As that voice rose from the palace, investor screens turned red, stock prices plunged, panic selling, portfolios wiped out, chaos ruled. But a few, just a few, leaned back calmly and silently whispered, "Let it begin." Because they weren't listening to King Ulrich, they were listening to time. Let's pause Ulrich's story for a moment. Let me tell you something real. Wars often boost the stock market. Yes, it sounds surprising, but let me explain quickly. During major global conflicts, Bosnia, Gulf War, Iraq War, the MSCI All-Country World Index delivered positive returns in the following 12 months. Yes, investors made money during war. How? Because markets don't fear wars as much as they fear uncertainty. Once war officially begins, it's no longer unknown. It becomes priced in, and that reduces volatility. Sure, short-term drops happen, but often markets recover faster than people expect. If wars destroyed markets, the world's top investors would have vanished by now. But they didn't. Because history shows this. Only about 200 years in human history were war-free. That means wars existed during 94% of our past. So how can investors earn profits when economies collapse and millions die? The answer is simple: by anticipating and sticking to the plan. It may sound strange, but historical data proves it. Wars don't usually come out of nowhere. They give signals. Political shifts, rising tensions. Markets start pricing them in beforehand. And when war finally starts, prices often react positively. According to Armbruster Capital Management, from 1926 to 2013, most wars had minimal impact on markets. With a few exceptions, the overall trend remained stable. But what if a war begins suddenly? That's a different story. It creates something called the war puzzle. Sudden events catch markets off guard. Investors panic. Sell-offs begin. And in Xland, that's exactly what happened. Breaking news flashed across financial channels. King Ulrich declares war. Island tensions escalate. And in that moment, markets turned blood red. Stocks plummeted. Young investors froze in shock. Some had only saved up for a few months. They didn't know what to do. One click, and their stocks were gone. Profits vanished. Panic spread like wildfire. But elsewhere, on a different screen, a different scene played out. Experienced investors sipped their coffee calmly. They checked their portfolios. Some stocks were down 15%, some 30%. But instead of panicking, they saw opportunity, because they knew this wasn't the first war, and it won't be the last. Sudden decisions like this trigger panic. Why? Because new investors didn't see it coming. They weren't ready. They sell cheap. And who buys? Calm, experienced investors. Because even in chaos, they know, don't panic, stick to strategy. These investors don't follow headlines. They focus on the long term. They see war not as fear, but as discount season in the market. And no, this is not just a story. History proves it. During WWII, those who panic sold lost everything, but by 1915, Dow Jones rose by 88%. When WWII began and Germany invaded Poland, markets dipped briefly, but bounced back within a year. During the Gulf War, 1990, S&P 500 dropped 5%, then rallied 17% before the war even ended. In 2022, as Russia invaded Ukraine, S&P 500 fell 7%, but recovered within months. Wars often don't cause long-term collapse. Instead, they birth new sectors, new winners. Why? Because markets can't stand uncertainty. When something might happen, prices reflect that risk. But once it does happen, the unknown disappears. Markets adjust. Strategic plans begin. Governments, companies, economies adapt, and a new balance forms. At that point, investors split into two camps. 1. The reactive investor hears the news, sells instantly, feels safe for a moment, but usually sells at the very bottom. The strategic investor asks deeper questions. Has uncertainty been removed? Are company fundamentals still solid? Is this a long-term buying opportunity? And usually, years later, these investors say, I built this portfolio during the war. So which sectors perform well during conflict? Defense. Governments boost military budgets. Energy. Geopolitical risks shake oil and gas prices. Agriculture and food. Nations prioritize food security. Gold and precious metals. Classic safe havens. Cybersecurity and tech. Wars are no longer just on land. They're digital too. Those who buy these sectors at the right time, with a long-term mindset, often earn life-changing returns. Back to the story. King Ulrich started the war. Some cursed him. Others called him a hero. But investment history didn't care about his decision. It only recorded how people reacted. And you, in your own investment journey, will face moments like this. News will hit. Markets will fall. People will scream, "Sell! It'll drop more!" Run! War is coming. Everything is over. But in that moment, you'll hear a voice. King Ulrich will whisper, "No one will search for gold at the end of this war. But you're already in the mine. If you dig with patience, the kingdom is yours." Remember, history isn't shaped by wars, but by those who kept their character during them. In investing, the true winners aren't the ones who hear the news first, but those who manage their emotions when fear takes over. The losers? They're the ones who surrender to panic. History always repeats itself. But is your investment strategy ready for that?